Netflix. I mean, what can you say? It's the king of streaming, a company that totally changed how we watch TV. But what happens when you take this high-flying growth stock and put it under the microscope of, say, the world's most famous value investor? That brings us to one simple question we're going to tackle today. Would Warren Buffett ever actually buy Netflix? Let's dive in and find out.
Yeah, let's just get right to the heart of it. Would the Oracle of Omaha himself, a guy who is famous for steering clear of a lot of tech stocks, ever consider adding a giant like Netflix to his portfolio? I mean, on the surface, it seems like a hard no, right? But as we're about to see, the answer is a little more complicated, and it might just surprise you.
And this is what makes it so interesting, because it really sets up this amazing paradox. On one hand, you've got Netflix, the ultimate symbol of disruption, of explosive growth. And on the other hand, you have the entire Buffett philosophy, which is all about finding wonderful companies, but, and this is the key, buying them at a fair price with a big margin of safety. I mean, these two worlds, they almost never collide.
Okay, so where do we even begin with this? Well, here's the thing. Before a value investor like Buffett even thinks about looking at the price tag, they ask a much more fundamental question. Is this a truly great business? So that's our first step. Let's peel back the layers here and see what really makes Netflix tick.
You see, Netflix's dominance really comes down to what we call a competitive moat, and theirs is built on four massive pillars. First, the brand. I mean, come on, it's so powerful, it's literally a verb, right? Netflix and chill. Then you've got its sheer global scale. We're talking a reach that no competitor can even touch. Throw in a gigantic exclusive content library and that spooky good recommendation engine that just keeps you watching, and, well, you've got a killer recipe for success.
So, how does this empire actually make its money? You hear a lot of talk about their new advertising tier, but the reality? It's way simpler than that. Overwhelmingly, Netflix is a subscription machine. Pure and simple. That steady, predictable, recurring revenue, that's the lifeblood of the entire company. It's what funds everything from Stranger Things to all those big blockbuster movies.
And this number right here, this is the key to everything. Over 300 million paid subscribers. Just think about that scale. That's what allows Netflix to drop billions and billions of dollars on new content, because they can spread that huge cost over an enormous user base. It's an advantage that their smaller competitors, well, they just can't compete with.
Okay, but for all these strengths, Netflix had this one, let's call it a dark secret, that kept value investors like Buffett far, far away for years. And that secret was, it was a cash-burning machine. It just torched money. But here's the thing, that's all changed. Let's look at what might be the most important part of this story, the company's incredible financial turnaround.
Man, this chart tells such a powerful story. You just have to look at it. Just a few years back, in 2019, Netflix was in the red by over $3 billion. Fast forward to 2023, and it's generating almost $7 billion in positive free cash flow. This isn't just a small change. This is a total game changer. And honestly, it's the reason we can even ask our Buffett question today.
And I really want to hammer this point home. Without that fundamental shift from being a cash burner to a cash generator, this whole conversation would be a non-starter. A value investor wouldn't even open the book on the company. But now that Netflix is actually printing cash, well, the game is on. All right, so let's recap. We've established it's a great business. We've seen that it's finally printing cash. So now it's time for the moment of truth. Let's put Netflix to the test. Let's run it through the classic Buffett checklist and see how it really scores.
First up, the classic price-to-earnings ratio, the PE. It's basically a quick snapshot of how much you're paying for the company's profits. Now, Buffett, he's a stickler for value. He typically wants to see a PE of 15 or even less. And Netflix? Well, it's sitting at around 44. Whoa, that is a huge premium. And for a value investor, that's immediately a big red flag.
Okay, next, let's look at the price-to-book ratio. The easiest way to think about this is, if Netflix had to sell off everything it owns, all its studios, its servers, everything, what would be left on paper per share? Buffett likes to buy a company for a price that's pretty close to that number. With Netflix, investors are paying almost 16 times its book value. That tells you you're not paying for assets. You are betting big, and I mean big, on future growth and the power of that brand.
But wait, here's where the story takes a really interesting turn. Let's talk about debt. Back in 2019, its debt-to-equity ratio was almost 2.
That's way too high for a conservative investor. It's a danger zone. But look at the change. By 2024, they'd wrestled that number all the way down to 0.62. This is a massive improvement, and it shows that management has gotten really serious about cleaning up the balance sheet.
Okay, so let's tally up the final scorecard here. On the strict valuation tests, like PE and PB, it's a clear fail. And on historical consistency, that steady, predictable 10-year growth, another fail, because it just hasn't been that smooth. But look where it passes. Return on equity, book value growth, these are excellent. These are the markers of a really high-quality, profitable business. So what we're left with is a very, very mixed picture.
So we've got a great business, no doubt, but it comes with a seriously high price tag. And that brings us to the real million-dollar question, or in this case, a couple $100 billion question: what is Netflix actually worth? To figure that out, we got to dig a little deeper into the numbers. And to figure out that true intrinsic value, we're going to pull out a favorite tool from the Value Investor's Toolbox, the Discounted Cash Flow Analysis, or DCF. It sounds complicated, but the idea is simple. It's kind of like a time machine for money. You try to predict all the cash Netflix is going to make in the future, and then you pull all of that back to today to see what it's worth in present-day dollars. All right, let's run some scenarios. First, let's be conservative. What if Netflix's growth really slows down, say to a pretty modest 6% a year? If that happens, our DCF model spits out a value of about $272 a share. Okay, what about a more normal case? Let's call it the base case. We'll assume a much healthier cash flow growth of, say, 15% a year. In that scenario, the value pops up to $393 a share. Makes sense. All right, now let's get super optimistic. Let's say Netflix just crushes it. The ad business explodes, subscriber growth goes through the roof, everything goes right. Even in that best case, blue sky scenario, our model puts the company's value at around $576 a share. Remember that number. So, there you have it. Our rational valuation range is somewhere between, let's say, $272 on the low end and $576 on the absolute high end. So, what's the actual price you'd pay for it on the stock market today? Roughly $1,200 a share. Yeah. The difference is just staggering. And this is the key takeaway from all that math. The market price isn't just making in a little optimism. It is pricing in a level of growth and future success that is just, well, it's way beyond what even our most bullish but still rational financial models can justify. The current price assumes that pretty much everything will go perfectly for Netflix for years and years to come. So, what in the world is an investor supposed to do with this information? This is the ultimate dilemma, right? You've got a fantastic, high-quality company trading at a sky-high price. It's the classic battle, quality versus value. And this brings us right back to where we started. It highlights this profound difference between a great business and a great investment. And they are not always the same thing. Is Netflix a great business? Oh, absolutely, without a doubt. But at today's prices, is it a great investment? Well, if you're looking at it through the strict lens of a value investor, the answer is a pretty resounding no. And so that leaves us with this final, really tantalizing question. For a company this dominant, this powerful, is waiting around for the perfect price the smart, disciplined thing to do? Or is it just a trap, a recipe for missing out entirely on a truly once-in-a-generation story? That, right there, is the billion-dollar question that every single investor has to wrestle with and answer for themselves.